Hey everybody, Chuck Carnevale here with my Tuesday subscriber request series, Fast Graph video. This particular week I'm going to be covering semiconductors and semiconductor equipment. I've had requests to cover 7 of those companies, so if I've excluded any companies, it's simply because you didn't ask me to cover them. But, I'm also going to bring out a very strong and important point. One of the things I learned, I tried to learn all my investing by studying the masters. Those investors who've produced the best records and have the best reputations over long periods of time. Those investors who've produced the best long-term records and actually have the best reputations over time. And of course, I'm always looking at the sound fundamental value investors to take my lead. And one of them, of course, is the venerable Warren Buffett. And everybody knows him and what he's done and what he stands for. But one of his principles that he talks about all the time is invest in things that you know something about. Invest in companies that you know and understand. That's very critical. Well, even Warren has, I guess, violated that principle because if I'm not mistaken, he has positions in names like Apple and so on. But for the longest time, he avoided names even like Microsoft, even though he allegedly plays bridge with Bill Gates quite a bit. But the point is, these are very complex businesses, and the technology surrounding these businesses and that makes and produces the products and services that they provide are very complex and far beyond my pay grade. What I do understand, I think, are the numbers and the numbers that these businesses and industries have produced. So, with all due respect, I'm going to be covering that portion of these companies. I'm going to show you some insights as best I can into what each of these businesses do, but my primary role here is going to be looking at them by the numbers. That's going to be the key of this particular video. So let's look at the 7 companies I'm going to be covering. I've got them listed here in order of market cap, highest to lowest. So the smallest market cap is Marvell Technology, Inc., but it's a $32 billion company, a semiconductor manufacturer. KLAC, KLA Corp, is a $48 billion company. Lam Research is a $90 billion company. Advanced Micro Devices, a big competitor of Intel, is a $94 billion company. Broadcom, $187 billion. Intel, $230 billion. And then the big one here is Nvidia, with $388 billion. And I'll be covering all of these, and they're either in semiconductors or semiconductor equipment. So I'm going to go through these one at a time with you and just try to give you some introduction at first, and then I'll come back and look at the numbers in more detail. The first would be Marvell Technologies. And again, for those of you who aren't familiar with the fast graphs, the orange line plots earnings per share. The white line plots dividends. The light green shaded area represents this portion of earnings underneath the dividend line that are paid out. When you see a cyclical stock like this, those dividends look lumpy. That's why we produce it both ways. Then we provide a normal PE, which is a mathematical calculation, which in this case is distorted. But what I really want you to see here, Marvell has been a very cyclical company, and I'll be talking about that in more detail. One of the things I like to do is go directly into the company's website via fast graphs and look at what the company does, what their products are, and what they do. And again, this is very, very complex when you're looking at a company like this. You can look at their products, you can go through this here and see the different things that they build and make. In other words, I would spend some time, if you're interested in any of these companies after I'm done, spending some time on their website. But again, I don't consider myself an expert in any of them. KLA Corp, again, is another one. Now, this has more growthy characteristic than cyclicality, but I do want you to note that there has been cyclicality. The company, did very poorly during the Great Recession. They even had some weakness coming out of the 2001 recession, so you want to pay attention to that. Note, though, that the growth in recent years has been very, very strong, and that's going to become an important part of what I'm talking about. This particular company is involved in, the technology as well, with making parts and chips and so on that, supply all of these different products here. And, like they say, whether it's a driverless car, a virtual reality experience, or factory robots, we help turn them into possibility. So that's KLA. Lam Research, which is one I've been asked about quite a bit, has a very similar characteristics to what we just saw, a very similar industry. Again, it's more of a growth company than it is a cyclical, but it does have cyclicality. Again, I'll come back to all of this. Every leading edge device has been made using our equipment, according to Lam. So that's something, again, you can spend a lot of time in the company's websites if you're interested in these companies trying to figure out what they actually do. Advanced Micro Devices is basically a chip manufacturer. They've been, fighting with Intel for as long as I can remember, to supply the chips and replace the Intel inside chips. But anyway, AMD's a formidable competitor today. I also want you to note that their earnings growth has been relatively strong in the last 4 or 5 years. Broadcom, I'm going to, for disclosure, I'm long Broadcom. This will be one that I'll talk a little bit more on. It's very, very interesting. I think it has a great deal of potential. And I bought it when it was a little better valued than it is now. It's moderately overvalued, but reasonably valued. And you might have noticed most of these others have been overvalued. Intel, of course, is not overvalued, but Intel has a great deal of cyclicality, but a decent amount of growth baked in at the same time, and you can buy it at a relatively low valuation. I'll talk more about it, and I'm not going to spend a lot of time. We all know what Intel and what they do. And then Nvidia, of course, I want you to note how weak the growth was all these years, and then it grew, very fast. And their basic, story claim to fame here is in gaming and artificial intelligence and things like that. So you want to spend some time learning about each of these companies. But let's go back to the beginning here, and let's start with our first one, Marvell Technologies. And what I want to do is I want to kind of go through the numbers with you. Let's start by looking at performance. Historical performance going back to 2000 actually outperformed the market pretty dramatically. It didn't in terms of dividend income, but they've only been paying a dividend since 2013, so that's not a fair comparison. But they've definitely outperformed the average company, but it's been a very roller coaster ride. And I do want to make that clear. If I use I'm going to first of all take the normal PE off here to give you a better perspective of how cyclical this particular company is. I'm going to use my scroll bar here, and I'm going to go back in time and get rid of some of the data. When I look at performance from 2000 all the way through 2015, now it gets a little more, market-like. It still has good performance, but here's what I want you to see. Had you bought this stock at the beginning of the year in 2002, after it had fallen from a very high valuation, now the PE was 41, but I want you to notice the growth that the company strung together for these 3 years. In 2003, it grew by 200%, followed by 98%, followed by 76% and 62%. This is a very important point that I want to try to get across here. When you're using, if those of you who are using the FastGraphs Fundamentals Analyzer software tool, it's an analytical tool. You just don't look at a long-term graph and immediately draw conclusions. You have to analyze what you're looking at. Now, during this time frame, if I go from the trough valuation or to the peak, this company would have generated a 90% annualized rate of return, or in a span of 3 years, you'd have made 6 times your money on your investment. That's the power of investing in these cyclicals at the right side, especially these semiconductor cyclicals that can have very powerful periods of growth. But I also want you to notice the flip side of that, and that is that had you bought it at the peak and drove it to the bottom, you would have lost 83% of your money over another, the next 3-year period of time, had you held on or, simply was, aggressive enough to be buying it when everybody else was buying it. That's what drove the price up. So you can see there's an awful lot of cyclicality here. And performance is kind of tough to measure because you go through periods of time where, here's a $31 price going all the way out. Here the price is $16. There you're losing, roughly half of your money over a period of time, or, your price got cut in half over a long period of time. And then it was followed by this, huge run up in value here. So that's one thing about these stocks, is that they're very, very cyclical. Now, most of them have started to pay dividends now, as you notice. If I go back to the portfolio review here, and if I go ahead and add dividend yield to the portfolio review, I now have put dividend yield on here. You can see that only one of them, the only one that doesn't pay a dividend, is Advanced Micro Devices. So, and I believe that's true. Anyway, we'll get into that here in a moment. But the point is, these are really kind of cyclical, growthier stocks. Now, in recent times, their growth has accelerated, and there's also been a very big supply shortage of chips, and that's also causing some weakness in some of these stocks. So I just want you to be aware of the nature of the beast. That's the point of this discussion. Because let's look at a couple of things here about forecasting. Now, when I look at forecasts, Marvell is expected to grow at 29% a year over the next 3 years. The long-term trend line growth is very similar at 26%. Now, even though these stocks are very highly valued, if they were able to produce this kind of growth, you could still earn double-digit rates of return. But I do want to point out, you'd have been better off, obviously, had you bought these stocks when they were, trading down here at reasonable values. Like you could have bought this stock in October of 2018 at a 14 PE. I want you to be aware of that. And I want you to note that, the stock got into very high PEs here, but it got into ridiculously high PEs here, and then the valuation dropped and the PE got down all the way to, single digits. So there's PE fluctuation as well as price fluctuation here that you need to be aware of. And this is one of the issues I think that I really want to focus you on also, is these companies, because of their cyclical nature, are not easy to forecast. You can see analysts have been wrong 33% of the time, given a 10% margin of error on a 1-year forward forecast and 42% of the time on a 2-year forward forecast. And, you can see that sometimes these estimates have been, they were actually forecasting for 2013 $1.82, for example, and the company only earned 86 cents. That was over 100% miss. Some of these misses are huge. They're not just a penny here and a penny there like you see, with a lot of companies. So these are very, very tough companies to analyze. Now, I want to go ahead and look at KLA Corporation. Again, I want to use my scroll bar here and have a little fun with, how you can see some of these numbers and what happens. When I look back on this stock, and I ended at 2011 from 2001, the price of this stock really didn't do anything. My performance during this time frame was only about 3% annualized capital gain-wise, and I add a little dividend income. And, I made, very modest rates of return. The company started paying their dividend in 2005. But as you can see, these are very, very cyclical companies. Now, I'm going to go through this later. I'm going to talk about the profit margins here because I want you to see that these companies have very fluctuating profit margins. But anyway, I think you get the picture. Now, the more recent performance of the company has been very, very strong, where capital appreciation has slightly exceeded 23%, add in dividends, and you make over 24%. You turn a 10, this is an 8-bagger, if you will, that turned 10,000 into 84,000, including dividends not reinvested. And keep in mind, you'd have tripled your money in the market in an index fund during this same time frame, given the fact that the indices have also done extremely well during this period of time. But I do want you to note the very high valuation. The company separated from its valuation. When I look at it from a forecasting point of view, it's barely outside of what I call my valuation corridor here. It would indicate, single-digit returns, but if I price it at its normal multiple, which has been about 16 over the last 5 years, and if I look at multiples again, they range from 20 down to the 15, but a 15 or 16 multiple has been very, very common here. So if that's the case, there's not a lot of upside over the next year or two. And even with a 14% longer term trend line growth rate, you still have low single digit returns. That's based on the fact that the prices are already high. The point I'm trying to make here, and I want you to try to understand this clearly, is this would have been the time to be buying KLA, for example, not now when the price is excessively high. Now I go into Lam Research, I got exactly the same situation. The time to have bought it would have been in 2018 or 19, 17, when the price was trading at a very reasonable PE ratio of about 15. Now you've got almost a 25 multiple, and that's getting pretty pricey. Now the business is expected to grow. This one could actually produce modest rates of return. But when I look at the normal multiple, which for the last 5 years, which has been 14, you could face some losses. Long-term trend line growth, however, is expected to be very, very strong, which means you could make, double-digit returns if you bought it and held it, and were even maybe willing to add money if it reverted to the mean and got back down to these orange lines. These are very, very cyclical companies. Again, they're very difficult to analyze. The analysts miss the estimates by about 1/3 of the time, and there are times when they miss them by these huge margins. This is something that's kind of a nature of the beast, if you will. Advanced Micro Devices is very interesting. For years and years and years, they suffered, fighting with Intel. They would occasionally generate some profits, but they would also string together, long periods of time of losses. They were actually a negative rate of return generator from 2001 all the way through 2014. I want to make that clear. Very cyclical. Now, again, there were times where you could have bought the stock and generated these monstrous rates of return, when the earnings were growing, and a lot of this is market hype. But then at the same time, this really defies the risk that I often talked about with valuation, because now you could have lost 94% of your money over the next 3 or 4 years once the cycle turned bad on them. Now, as I move my scroll bar forward here, you start to see that the company begins to start generating some profitability in 2016 and 17, and even through 2019, the COVID period, we saw some real nice growth. So if I shorten this time frame for 5 years, and I want you to be very careful with this, because if you're doing this, and I always encourage subscribers in Fast Graphs to do this, I want you to note that now all of a sudden the growth rate is averaging 47%, almost 48% a year. That's 39, 100, 67, 23, and 23. But note this, it's expected to slow down going forward. So now we're using the P equals growth rate, or we're using a fair value PE for this time frame of 48 times earnings. I think common sense will tell you that's probably not sustainable. So when I move to forecasting and I'm looking at numbers like 25% growth, that would indicate that the stock could be very, very, excessively valued. Now, if I go back to this normal PE that we had for the last 5 years, which is really very close to what I'm showing you here, I just add a couple of years to this, you get this very high valuation, but, the earnings really didn't justify it here. But the point is, this is an analytical tool. Just don't look at the graph and automatically say it's overvalued or undervalued. Make sure you're analyzing what you're looking at and then trying to determine if it makes sense. A 60 multiple is extremely high. If I look at the long-term historical multiples of this company, though, they've always been high. That's what's interesting. Now, that could be very misleading in its own right, because the reason they are so high is because when you're averaging these PEs, like, you have a PE here of 65 on this calculation here, and even here you have no meaningful numbers because there is no earnings, so you get kind of a distorted view, and then your normal PE comes out at 44 or 45. But keep in mind, it's averaging in real high valuations with zero valuations. So analyze what you're looking at. The nature of the beast is these are very, very cyclical companies. Broadcom now, just been public since August of 2009, came out at around $18 a share. Here's another example where you've got to look at the numbers that are generating these numbers that you see in the color-coded box on your Fast Facts. In 2010, they had a 1,190% increase in earnings. Okay, they went from a negative rate of return to a positive $2.19. If I cut those numbers out and get into these more realistic numbers, now my growth is more like 24 or 25%. But even that number is convoluted by 4% growth, averaging with 70 and 83, and then 28 and 40 and 30, and then only 2, and then 4, and then 21 and 8 and 7. So the point is, there is a level of cyclicality, even though this looks like it's much more growthy than perhaps it might actually be. And I actually own this one. This is one that I'm long in. Now, when I look at forecasting, forecasts are expected to grow by about 12% a year. The long-term trend line forecast about 16% a year, which would make this very attractive as a long-term investment, double-digit return potential, even at today's valuation. But I want to point out, the blue line is what I really pay. People ask me this question all the time. I just simply look at what the market has done here. And this, the normal PE is simply the average valuation, trimmed average that the market has applied to the stock. And as you can see, this has been about a 14 or 15 multiple, which is typical for many stocks. So now at an 18 PE, you would argue it's a little high. The earnings yield's only 5%. Now it does give me a very attractive dividend yield. But again, I was investing in Broadcom back here when it was trading at 11 and 12 PEs. So, I've done well. But this stock does look very attractive here. When I look at the analyst scorecard, it's one of the few that has really an impeccable analyst scorecard. Over the period of time, the analysts have been forecasting here, they've got it right virtually 100% of the time. In fact, it's beat estimates more than half the time in both a 1 year and a 2 year forward. So when I'm looking at these numbers, I might feel a little better about the numbers that I'm seeing, the forecast that I'm seeing on Broadcom compared to some of the others. Now, Intel has become just a big behemoth, if you will, $230 billion market cap. It does only have 28% debt and it's A+ rated. It's pretty cyclical. Its performance has been good in terms of, it's generated a lot of dividend income and it's, almost doubled your money, but it's not great performance. Let's put it that way. And again, ultimately, it's the value of the business. Now, the reason it wasn't so good, though, and I always want to point this out, in January of 2002, the company was trading at 67 times earnings, and that's kind of what you're seeing now. And that was during a growth phase, but then the company reverted to the mean. If I call some years out of here, pull some years out of here, let me do two more here, and look at the company over since coming out of the 2009 recession, it's grown earnings at 11.5%. Now the performance is getting more market-like, but it did generate almost twice the dividend income. And, it came out with a close return to the market, but it was more of a dividend-paying stock, a dividend growth stock. And you can buy it today with a 2.4% dividend yield and 8.83 earnings yield, which I consider attractive at a PE of only 11. When I'm looking forward, though, analysts are expecting actually negative growth. We're expecting minimum to no growth for the next year or two. So now you have to take that into consideration. Are you willing to take the risk that this company's earnings growth is going to be dropping over the next couple of years? And so is Intel undervalued? Depends on, what time frame you're looking at and what you believe. I am also long Intel, but it's one that I'm watching very closely because of what I just showed you. And then Nvidia, this is a very popular stock, but once again, I want to point some things out. If I go back in time here, the growth rate was decent, but also very cyclical. And you can see the volatility that the company, generated here. I mean, you catch these semiconductors at the right time in the cycle, and you can make these incredible rates of return over short periods of time. But you've got to watch them. You got to be paying attention because as quickly as these returns happen, they can also disappear if you hit some bad times. Like of course here we had the recession where you would have seen an 80% drop, 79.4% drop in the value. Now all of a sudden we're starting to see really strong earnings growth. And it's getting, better and better. So that, as I change time frames, these numbers change dramatically. The company has actually grown at about 40% a year during this time frame. And when I look at performance here, I get incredible performance. This would have been a wonderful stock to own, since 2014. And by the way, it was reasonably priced at about a 30-ish PE back here, actually a 40 PE, well, 23 PE if I bought it in February of 2014. But you can see the price has tracked earnings, and now we've had this run up in earnings. And when I look at forecasting, I'm looking at 21% growth, which is awesome growth. But now I've got to pay, a PE of 56 to buy that growth. And that gives me an earnings yield of 1.78%, which frankly is simply not enough. And of course, there's virtually no dividend yield here. Long-term growth is also expected to be 18 to 20%. But again, it doesn't justify the high valuation you have on the stock today. Once again, we look at the analyst scorecard here, and we've had a couple of years on the 1 year where they've missed. On the 2 year, they've had more misses, which just indicates, again, that these are difficult companies to evaluate and for analysts to analyze. So that's something to be careful. Now, I'm going to end this presentation by going back, and I want to go back through these companies, and I want to show you their profit margins because I really want to emphasize the cyclical nature. You got to be careful. These aren't buy and hold or set and forget type companies. These are companies that need to be monitored constantly. You need to constantly be paying attention to their quarterly financials, how they're reporting, watch their margins. Now you can see some incredible margin. Sometimes the line graph really helps. The margins are all over the place on these companies. The blue line is net margin. The red line is gross margin. And you can see these companies go through, long periods of time or extended periods of time where their margins are just horrible. So that's Marvell. Let's go ahead and now let's look at Nvidia next. I just have them in order of how this drop down is. Once again, you see margins that go all over the place. They rise and fall. So you got to be very careful and very diligent when you're dealing with these kind of companies. I think that's probably the most important message I want to get across. Again, it's the same old song, though. In each of these cases, you're going to see there's times when they actually have zero net margin, when net margin actually turns negative if you will, and even though they generated some gross margin. So you have to be very, very careful with these companies. You know, let's look at AVGO, which is the one that I do own that had maybe the more consistent operating record of any of them here. They tended to produce, you know, margin a little more consistently, but even they had negative periods where they generate negative profit margins. Again, these are not, you know, for the weak at heart. I think you get the picture. You know, when you're going through these stocks, I kind of got lost on what my sequence was here. But it's the same story regardless. You know, you're dealing with very cyclical companies here that, you know, they have times when they grow very, very fast, and they have times when their businesses are very, very weak. And so if you're going to invest in them, you really got to pay attention to them. Right now, the valuations are very high. You've got Intel with a low PE, but, you know, expected to have very weak growth. And you have some of these others with much higher PEs that have good growth ahead of them. Broadcom is the one in the middle. It's the one that I like the best out of the group. From a standpoint of it's moderately overvalued, I would actually be looking to buy Broadcom on weakness, just so we're clear. Anyway, it's been Chuck Marvell saying thanks for watching. If you liked it, give me a thumbs up, ring the bell, you know, give me a like, subscribe to the channel if you haven't already. And this was a subscriber request series. Again, I want to remind you, these are stocks that were requested by subscribers for me to look at. They're not recommendations. And make sure you consider that, you know, when you're going through the research on any of them that struck your fancy. Thanks for watching.